Thanks for your company for the weekly wrap this Friday, the 30th of October. I'm Jessica Amir, a market analyst with Bell Direct. Well, the Aussie share market experienced its biggest pullback in about 6 months, losing 3.4% Monday to Thursday. Not a big surprise, though, as investors historically bunker down into a risk-off environment ahead of a US election. Investors have continued to sell out of cyclicals like energy, miners and the growth tech sector, and instead top up defensives like consumer staples, utilities and healthcare stocks. And this is expected to continue until an election result is known. A big part of the pullback, though, this week was that Germany entered a partial 1-month shutdown. France is entering a national lockdown Friday, and the UK may be forced into the same direction. So investors are questioning how much the global economic recovery will now be delayed. This is all on top of China reporting its highest new daily cases in 2 months, and the Midwest of America seeing record COVID-19 hospitalizations. But looking on the brighter side of life, despite the pullback, there were some noteworthy rallies on the ASX. Coca-Cola fizzed up the most this week, Monday to Thursday, up 16% to $12.42, almost erasing its COVID-19 losses on that $9.3 billion takeover offer for $12.75 a share. Now, 6 brokers say CCL shares are fairly valued now, saying to hold the stock subject to a counter offer. Vitamin maker Blackmores held its AGM, noting China sales kicked off well in FY21, pushing BKL shares up 14% to a 2-month high. PolyNovo shares are up about 9% to $270. That's a 3-month high on its skin regenerative product, receiving FDA approval in Taiwan. But in terms of the bigger picture and themes to consider, the first, another positive, it's a goodie. Australia's recession could now be over. Well, that's according to the RBA Deputy Governor, Guy Debelle, who's declared the nation is now on the other side of its first recession in 29 years, as he suggested the September quarter is likely to report positive growth instead of a small decline. So given the economy is recovering quicker than expected, despite Victoria being in lockdown, you'd think that rates won't be cut on Melbourne Cup Day. But, the market or consensus is expecting that rates will be cut to 0.1%. That's a brand new historical record low. But beyond that, the RBA's rate indicator tells us that futures traders are expecting rates to be cut to 0%. Well, technically, they think there's an 84% chance of a cut to 0. So why the cut, given the RBA previously said that a cut would just merely increase savings and see less spending, which is not what the RBA wants? Well, the last RBA meeting minutes alluded to supporting Australia at a global level. Now, to do this, a rate cut would be needed as it devalues the Australian dollar. And the RBA also implied external funding, i.e. going into further debt, weakens an economy and its ability to provide extra stimulus down the track. That said, we know more government and central bank stimulus is expected, which of course supports stock market sentiment. Now, the third big item to consider, the US election on Tuesday, the 3rd of November. That's Wednesday, our time. So consider that the Australian share market performance can often mirror US markets. And US market returns do differ depending on who's in power or on the throne, so to speak, in the US. So according to AMP Capital, the best returns historically occur under a Democratic presidency, with the S&P 500 up 14.6% per annum. Now, contrast that to a Republican presidency where returns average 9.8% per annum. We also know every year after a US election, the Aussie share market has historically rallied 6.5% to 40.2%. That's just looking at the returns on the ASX over the past 36 years. But 2021 could be different. A vaccine is not widely to be available until mid next year. Well, that's when it's expected. Now, despite that, some economists are expecting markets to rally over the next 12 months based on lower interest rates. So with that in mind, lower for longer interest rates, given the cost of capital is at record lows, Morgan Stanley sees M&A activity picking up. The investment bank has scanned the entire market for underappreciated stocks that are trading at a discount, have heavily spent on capital, and have less restrictive share registries. The bank came up with a long list of takeover targets to watch. Now, at the top of the list were a bunch of companies, including Main Pharma, Nufarm, Southern Cross Media, Computershare, Bravura, Infomedia, Iris, EML Payments, Estia Health, and Monash IVF. So looking at those stocks, it's worth considering which have buy ratings on them from investment analyst houses. Now, Nufarm is backed by Credit Suisse and UBS as a buy with $5.07 targets and $5.30 respective targets. Southern Cross Media is a UBS buy with a 20-cent target. Computershare is backed by UBS and Morgan Stanley as a buy with a $12.30 and $15.75 target. Bravura Macquarie buy, $5.50 target for that one. Infomedia is a UBS and Credit Suisse buy with a $2.15 and $2.50 respective target. And lastly, Monash IVF is a Morgan Stanley and Morgan's buy with a 76 and 65 cent target. So there's plenty to sink your teeth into. Thanks so much for your company this week. From all of us here at Bell Direct, have a happy and safe weekend. I'm Jessica Amir. Take care. Bye for now.